Attention Florida homeowners, your dream property is about to get a lot more expensive. As we move through 2026, a quiet crisis is unfolding in cities like Miami and Tampa, where soaring assessments are colliding with aggressive millage hikes. These are the 10 cities where tax bills are becoming unsustainable. If you own property in Florida, or plan to, you need to stay with us until the very end of this video. And if this kind of deep data-driven reporting is what you come here for, hit that subscribe button right now. Let's get into it. To understand why 2026 specifically has become a breaking point, you have to understand the ecosystem that was quietly holding property taxes in check for the past several years, and why that ecosystem is now collapsing. Florida's property tax structure rests on three major pillars. First, the homestead exemption, which shaves up to $50,000 off the taxable value of a primary residence. Second, the Save Our Homes cap, a 1992 constitutional amendment that limits annual assessment increases to 3%, or the rate of inflation, whichever is lower. And third, locally set millage rates, which are determined independently by counties, cities, school boards, and special districts. For years, that three-legged stool kept most long-term owners insulated from the worst of the market's appreciation. But that protection is now beginning to crack. Florida's statewide property tax collections have reached nearly $60 billion annually. And while the Save Our Homes cap protects long-term residents, it has created a two-tier system where new buyers absorb the full shock of reassessment at market value the moment they close on a property. That shock is enormous. Hillsborough County, home to Tampa, carries one of the highest effective rates in the state at approximately 1.01%. And strong market growth means large Save Our Homes benefits for existing owners, but catastrophic jumps for anyone new to the market. What makes 2026 different is the convergence of pressures. Home values appreciated dramatically through 2021, 2022, and into 2023, lifting assessed values across every county. At the same time, local governments, facing inflated operating costs, growing infrastructure backlogs, and post-storm repair bills, have been quietly ratcheting up their millage rates. Analysts predict that average millage rates will climb 5 to 7% statewide by 2026, especially in fast-growth counties like Miami-Dade, Pinellas, and Lee. That projection translates concretely. A home taxed at 1.25% today could face a rate of 1.35% within 12 months, an increase of $400 annually for simply doing nothing and owning your property. The political momentum behind relief proposals this year stems directly from Florida's recent property value surge. Many homeowners have watched their tax bills climb even with existing protections like the Save Our Homes assessment cap, creating widespread demand for relief that crosses traditional political lines. Governor DeSantis and House Speaker Perez both pushed hard for major reform this session. But as of May 2026, Florida property taxes remain unchanged. Neither the regular legislative session nor the April special session produced any law eliminating property taxes. Senate leadership raised concerns about how local governments would replace the lost revenue, particularly for essential services such as law enforcement, fire protection, and infrastructure. And as a result, the two chambers did not reach agreement before the close of the session. That means the relief that millions of Florida homeowners were counting on did not arrive. And it means every city on this list is operating under the same old pressure, with no relief valve in sight. The conventional narrative about Florida's property tax crisis centers on the coasts, Miami, Fort Lauderdale, the Barrier Islands. But the data in 2026 tells a more complicated story, one that reaches deep into the interior of the state, into cities that just a decade ago were considered affordable alternatives to the crowded coastline. Kissimmee sits in Osceola County, just south of Orlando, and it has absorbed an enormous wave of domestic migration over the past 5 years. Families priced out of Orlando, Tampa, and South Florida moved inland looking for value. What they found instead was a municipal government struggling to build roads, schools, and utilities, fast enough to serve a population that doubled in density faster than anyone planned for. The result is a compounding series of special assessment levies layered onto property bills, stormwater fees, road impact charges, and school board millage adjustments that individually seem minor but collectively represent a significant escalation. Orange County, which borders Kissamee's metro corridor, sees investment properties hit the 10% non-homestead cap regularly, a sign of how aggressively assessments are climbing in this region. Lakeland in Polk County sits almost perfectly in the geographic center of Florida. It has long been a logistics and distribution hub, but the residential market has transformed dramatically. New subdivisions have pushed outward in every direction, and the county commission has responded by tying infrastructure expansion to new property levies. School board referendums in Polk County have added incremental millage burdens that, combined with rising assessed values, are producing bills that long-term residents describe as unrecognizable compared to what they paid 5 years ago. Ocala is perhaps the most striking example of what happens when coastal migration collides with rural infrastructure budgets. Marion County's population has grown at a rate its government was not financially equipped to serve. Public safety bonds for new fire stations, expanded emergency services, and law enforcement facilities have been attached to the local millage in ways that are legal, but that have caught many homeowners completely off guard. From 2022 to 2024, property taxes saw the largest total increase in revenue among all major tax categories nationally, rising by more than $96 billion, a 13.7% jump. Ocala is a microcosm of that national phenomenon playing out in real time with limited state-level buffers to slow the impact on individual bills. Now we move to the coastline. And here, the situation is not simply about growth or migration pressure. It is about something more existential, the cost of staying in place on a shoreline that the ocean is actively reclaiming. Cape Coral is one of the most flood-exposed cities in the continental United States. After Hurricane Ian devastated Lee County in 2022, property insurance costs in Cape Coral did not simply rise. They became, for many residents, functionally unaffordable. But here is what many people miss. Rising insurance costs directly elevate the total cost of ownership, which influences assessed value calculations and triggers additional review cycles by county appraisers. Lee County is specifically identified as one of the counties seeing the fastest assessment increases in 2025 and 2026. Mandatory seawall inspection requirements and coastal hardening surcharges have been passed from the municipality to the individual property owner through special assessment lines on tax bills, charges that are separate from the millage rate and that are not subject to the standard caps that protect homestead properties. Sarasota carries one of the highest concentrations of luxury real estate on the Gulf Coast. When high-end development raises the baseline value of an area, it does not just affect the wealthy buyers who purchase those properties. It recalibrates the assessment reference points for every neighboring parcel. Long-term middle-income homeowners in Sarasota are being pulled upward in assessed value by the gravitational force of luxury construction around them. For the 2026 ballot, lawmakers had filed proposals specifically targeting Naples, Sarasota, and coastal retirement markets, citing the need for senior exemptions, long-term freezes, and renovation exclusions to offer concentrated relief for retirees and long-term residents. An acknowledgement that these cities represent a concentrated zone of crisis for older, fixed-income homeowners. St. Petersburg may be the most dramatic example of a city caught between two competing financial forces simultaneously. On one hand, the city faces pressure from state-level reform proposals that could strip away local tax revenue. On the other, it faces massive unfunded infrastructure needs. St. Petersburg's mayor told the St. Pete Catalyst that he will ask voters to approve a new property tax to support a general obligation bond issuance, specifically to fund $600 million in stormwater and water projects to address the city's flooding vulnerabilities. That bond, if approved by voters, would sit on top of existing levies, pushing St. Petersburg's total property tax burden into territory that could make it one of the most expensive coastal cities in the state for new buyers. City officials have already warned that if proposed state-level tax elimination measures were to pass, there is no plan for how the lost revenue would be offset, leaving residents exposed to a fiscal gap that would require either service cuts or alternative levies to fill. Broward County has long carried millage rates that outpace neighboring Palm Beach to the north and Miami-Dade to the south. But Fort Lauderdale specifically has seen a convergence of pressures: luxury condo development driving up coastal assessments, post-storm infrastructure repair bonds, and a school board that has consistently sought voter approval for additional millage above the statutory cap. The combination has produced a property tax environment that punishes new buyers with sticker shock, while quietly eroding the purchasing power of existing homeowners who are seeing their bills climb 3 to 5% annually, even under Save Our Homes protection. The final 3 cities on this list share a specific and particularly painful dynamic. They are places where luxury development has been used as a growth engine, where new high-end construction was welcomed as a sign of prosperity, but where the tax implications of that development have landed hardest on the people who are already there. Orlando ranked 11th nationally in property tax escalation between 2021 and 2023, recording a 17.1% change in that window, with the median bill rising from $2,213 to $2,592. But that figure represents a baseline. In 2025 and into 2026, the pressure has intensified. Orange County's tourism-driven economy generates enormous short-term rental activity, and non-homestead investment properties, which carry a 10% annual assessment cap rather than the 3% homestead cap, have been routinely hitting that ceiling. The practical consequence is that the millage burden is shared across a tax base where median income homeowners are competing with institutional investors for value positioning and losing. Jacksonville has seen property taxes surge 59.6% since 2019, bringing the median monthly property tax payment to $228. That makes it one of the most dramatic sustained escalations of any major metro in the country. Duval County is the fastest growing metro in the state, and assessment increases are accelerating. What makes Jacksonville's situation particularly acute is the income profile of its population. This is not a city of luxury buyers absorbing tax increases as a rounding error on $1 million investment. Jacksonville's median household income sits significantly below those of Miami or Tampa, which means the percentage of disposable income consumed by property taxes is disproportionately higher. Long-term homeowners who purchased in the early 2000s are being confronted with bills that have nearly doubled in real terms over the past decade. We have to honor the data here. Tampa topped the national list for property tax increases between 2021 and 2023, with a 23.3% surge in just 2 years, rising from a median annual bill of $1,935 in 2021 to $2,385 in 2023. And Tampa's median monthly housing payment has climbed 112.4% since 2019, placing it among the most burdened housing markets in the entire country. Miami, meanwhile, represents a different category of crisis, one of scale. The median total monthly housing payment in Miami now stands at $4,401, a 125.7% increase since 2019, with the median monthly property tax component reaching $367. Miami-Dade County's effective property tax rate sits at approximately 0.91%, and new buyers face severe assessment recapture, meaning that the moment a property changes hands, the full market value is locked in as the assessment baseline, stripping away any Save Our Homes protection the previous owner had accumulated over years or decades. Millage rates in Miami-Dade, Pinellas, and Lee are on a trajectory that analysts project will mean even a $400,000 home that costs $5,000 annually today could cost $5,400 or more by the end of this cycle, without the owner making any change to the property, without any renovation, and without any increase in their personal income to absorb the difference. Now that we have laid out the scope of the crisis, we need to talk about what you can actually do about it. Because there are real concrete steps available to Florida homeowners, but they come with hard deadlines, and missing them is costly. If you believe your assessment does not reflect your property's true market value, you have the right to challenge it. You have exactly 25 days from the trim, or truth in millage, notice mailing date to file a petition. That deadline is strict. It runs from the date the notice was mailed, not the date you received it, and the exact deadline is printed on the notice itself. Missing it means waiting a full year for another opportunity. The trim notice is typically mailed around August 11th, making the 2026 appeal deadline approximately September 5th, 2026. The VAB process is free. You can represent yourself, and you should bring comparable sales evidence showing that your assessed value exceeds what the market would actually bear for your property. The homestead exemption remains Florida's most powerful individual tax tool. It removes up to $50,000 from your home's taxable value and locks in your assessment under the Save Our Homes cap going forward. The filing deadline is March 1st of the relevant tax year. For veterans, the picture is even more favorable. Disabled veterans who qualify are entitled to percentage discounts equal to their service-connected disability rating, and those who are totally and permanently disabled may qualify for a complete exemption. The VAB appeal process is free, and veterans can represent themselves. The key is filing Form DR 501 with the county property appraiser before the deadline. The deadline for most veteran exemptions for the 2026 tax year was March 1st, 2026. But many counties accept late applications until 25 days after trim notices are mailed in late August, particularly for recently discharged veterans or those who have experienced a change in disability rating. For seniors, Florida offers an additional exemption for residents age 65 and older who have maintained permanent residence for at least 25 years and whose household adjusted gross income does not exceed the annual limit, set at $38,686 for 2026, on properties with a market value below $250,000. If you are a long-term Florida senior homeowner and you have not applied for this exemption, you may be leaving substantial savings on the table every single year. This is critical context for 2026. There was enormous legislative energy directed at property tax reform this year. The Florida House passed a major reform measure in February. But as of May 2026, no constitutional amendment has been finalized for the ballot, no immediate elimination of property taxes is in effect, and no changes have been made to how property taxes are calculated or collected. Property taxes in Florida continue under the existing structure. That means the burden of protecting yourself falls entirely on your own actions, on filing exemptions, meeting deadlines, and being willing to challenge assessments when the numbers do not reflect reality. Looking forward, the trajectory of Florida's property tax burden through the end of this decade is unlikely to ease on its own. Population growth continues. Infrastructure deficits are real. Climate adaptation costs are accelerating. In Miami-Dade County alone, Biscayne Bay supports approximately $64 billion in economic output, 448,000 jobs, and around $4 billion in annual tax revenue. And protecting those assets from sea level rise and storm damage requires funding that must come from somewhere. For the foreseeable future, that somewhere is your property tax bill. The 10 cities we covered today, Kissimmee, Lakeland, Ocala, Cape Coral, Sarasota, St. Petersburg, Fort Lauderdale, Orlando, Jacksonville, and the dual epicenter of Tampa and Miami, represent the sharpest edges of a statewide shift. The Sunshine State is no longer the automatic tax haven it once was. The math has changed, the bills have arrived, and the political cavalry that many homeowners were counting on in 2026 did not ride in. But knowledge is leverage. Knowing your deadlines, knowing your exemptions, and knowing your right to challenge an assessment, those are not small things. They are the difference between absorbing a burden quietly and actively fighting to reduce it. To every homeowner, every landlord, every buyer, every renter watching this, thank you, genuinely. The fact that you are here, doing this research, asking these questions, and taking your financial future seriously is exactly what we built this channel for. We see you, and we respect the work it takes to stay informed in an environment this complex. If this video gave you something useful, please subscribe. It takes 1 second, and it means we can keep making content at this level of depth and accuracy.
Share this with someone who owns property in Florida. They need to see it. And drop a comment below telling us which city you are in and what you are seeing on your own tax bill. We read every single one, Until next time, stay sharp, stay informed, and never stop asking the hard questions about where your money is going. We will see you in the next one.